Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, January the 11th, and I want to take just a brief minute to discuss what markets did in their first week of the year for 2024. The markets took a pause after 9 straight weeks of continuous gains in the S&P to end out the year in 2023. The S&P 500 was down 1.52% on the week. The mid-cap index, as measured by the S&P 400, was down 2.48%, and the small caps were down the worst, down 3.6% as measured by the S&P 600. And that's no surprise coming off of the rally that we had to end the year. We need a bit of digestion. Nothing continues in a straight line forever in the equity markets. There comes a time where we've hit peak valuations, news has been priced in, and now we need to wait and see what comes to fruition from those particular names and those equities. And so we've talked about so much going into last year was led by those 7 names, and what was encouraging about the last 9 weeks of the market action as we ended 2023 is you saw the rotation out of those magnificent 7 into the stocks that have been left behind and were cheap and had great value to them. Now those are being bidded up as well, and so what we're seeing now is a period of just digestion in the market. So you had 9 weeks of those stocks coming up, your Magnificent 7 treading water, moving up slightly, and now as we're heading into 2024, we're getting bits and starts of this rotation. Is the rotation going to continue? Then we get news of new AI technology, and those Magnificent 7 names take over the mantle again and run. But what the encouraging thing that we've seen in the equity markets so far to start 2024 is whenever there's a dip or a down day in the equity markets, there's buying pressure that's coming in, and we're seeing the market get bought when there is an opportunity to get bought. And today is another good example. We started the market, pre-market was higher ahead of today's CPI report that we got at 8:30 this morning, which came in 1/10 higher than expectations. But the encouraging thing is, for the first time, core CPE, which is what is the Fed's favorite measure of inflation, broke below 4% for the month of December. It came in at 3.9%, and that was encouraging. And that, however, with it being hotter than expected, there was a probability of rate cuts by the Fed in March. With the CPI report being a little bit higher than expectations, you can probably expect those March cuts are probably off the table. And again, the same thing applies to inflation coming down as the equity markets going up for 9 straight weeks. Inflation is not going to come down in a straight line and be perfect. You're going to have fits and starts as you're on your way down. If you look at a historic chart of the S&P 500 going back 100 years, or going back and look at the 20th century, it starts down here and it works its way up, but it's not a straight line up. It zigs and it zags, and it comes up and down as peaks and valleys. And that's the same thing that you can expect for inflation, and we really believe that it's going to be sticky here right around this 3% mark. However, at the same time, you have short-term rates that are 5.5% on the short-term rates that need to come down just because they're so restrictive over the inflationary rate. So at some point, the Fed is going to lower those short-term rates. However, the long-term rates, if you look at the 10-year and things along those lines, you've seen those kind of tick up recently, and expect some of that to continue to happen as we normalize. And what we have to remember is you can still make money in the equity markets with a 4.5% treasury on the 10-year. It's been done. We did it in the 90s, made a lot of money. Companies are still profitable. You can still make money. Margins are still good when you're running through interest rates at 4.5%. Historically, those are still actually pretty low rates and very good for stimulating economic growth and activity. They're not that restrictive. So we really don't see the catalyst to take this market down severely and have a severe correction that maybe some are calling for. As you remember when we spoke last week, we expected there to be volatility throughout this year. It's an election year. There's no telling what may or may not happen with that, or macro events. The economy is normalizing again, and we're getting back to that normal growth. And it's always going to have that wall of worry. Credit card balances are up. Debt's up. What are we going to do about that? Well, the great thing is wages are keeping up with inflation, but we will see some type of reckoning at some point with those two data points. Either inflation needs to continue to come down or wages need to continue to go up. So if you have questions about how to navigate this portfolio and how to get through 2024, give us a call. We'd love the opportunity to speak with you. You can reach us at 904-346-3460. As always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.